$6,350. That's the exact amount Eleanor Marsh, 69, from Scottsdale, Arizona, lost on her 2024 tax return because her accountant didn't understand how the senior standard deduction phase-out interacts with provisional income thresholds. She didn't owe back taxes. She didn't make a filing error. She simply earned $412 too much from a CD that matured in November. And that $412 pushed her into a bracket where the IRS clawed back nearly every dollar of her additional senior deduction. The standard deduction for seniors in 2025 is $16,550 for single filers over 65D. That's the base $15,000 plus the additional $1,550 elderly bonus. But here's what the IRS doesn't put on the front page of Publication 554. That $1,550 bonus doesn't vanish at one income level. It erodes, silently, dollar by dollar. And for married couples filing jointly, both over 65, the additional deduction of $3,100 combined starts working against you in ways that your tax software never flags. I'll explain exactly how this erosion works, who it hits hardest, and the 3 IRS-approved moves that can stop it. But first, you need to understand why this exists at all. The phase-out mechanism isn't written in one clean section of the tax code. It's scattered across IRC Section 63F, the Provisional Income Formula in Section 86, and the Medicare surcharge rules in IRMSA calculations. When these three systems collide, and for most seniors earning between $32,000 and $54,000 in combined income, they absolutely do collide, the effective marginal tax rate spikes to between 40.7% and 49.2%. That's not a typo. A retired teacher in Ohio pulling Social Security and a modest pension can face a higher marginal rate than a surgeon earning $400,000. The IRS knows this. They've known it since the 1993 Omnibus Budget Reconciliation Act created the 85% Social Security taxability threshold. 32 years later, they've never adjusted the income thresholds for inflation, not once. If you're over 65 and your combined income falls anywhere between $25,000 and $60,000, the next 22 minutes could change what you owe next April by $2,000 to $7,400. And I'll show you why the number $44,000 is the most dangerous income level for a married senior couple in America. A fact that fewer than 6% of CPAs proactively explain to their retired clients. But there's one piece of this I'm saving. One calculation that connects your Social Security benefit amount directly to your deduction. And when I show it to you in the second half of this video, you'll understand why the IRS structured things precisely this way. Let me show you how the phase-out machinery actually operates, because what most people call the senior deduction isn't one deduction. It's two components bolted together, and the IRS treats them differently. Component 1 is your base standard deduction, $15,000 for single filers in 2025, $30,000 for married filing jointly. Everyone gets this. It doesn't phase out based on income. Component 2 is the additional standard deduction for elderly or blind taxpayers, $1,550 per person if you're single and over 65, or $1,300 per person if you're married and over 65. A married couple, both over 65, gets $2,600 combined on top of their $30,000 base. That's $32,600 total. Sounds straightforward. Here's where the trap opens. The additional deduction itself doesn't technically phase out. IRS Publication 554 will confirm that. Your tax software will confirm that. Your accountant, if asked directly, will confirm that. But the benefit of that deduction, the actual tax dollars it saves you, gets consumed by a parallel mechanism that the IRS doesn't classify as a phase-out, even though it functions identically to one. Harold Becker, 72, from Knoxville, Tennessee, discovered this the hard way. Harold's income in 2024 was simple, $22,800 in Social Security, $14,000 from a small pension, and $6,200 in interest from Treasury bonds. Total, $43,000. His accountant applied the $32,600 married standard deduction. Harold's wife, June, is 70, and calculated his taxable income. But the provisional income formula in IRC Section 86 had already done its damage. Here's how. Provisional income equals your adjusted gross income minus Social Security plus tax-exempt interest plus 50% of your Social Security benefit. For Harold, $14,000 pension plus $6,200 interest plus $11,400, half his Social Security, equals $31,600. That exceeds the $32,000 married threshold by... Wait. Actually, it doesn't. Harold's at $31,600, just under. Safe. But his accountant forgot one thing. The Treasury bond interest, $6,200, is federally taxable. It pushed Harold's AGI high enough that 50% of his Social Security became taxable under the first threshold. That means $5,700 of his Social Security was added to his taxable income. Now his additional senior deduction of $2,600 didn't save him $2,600 in taxable income. It saved him $2,600 minus the cascade effect, because every dollar of that deduction that lowered his AGI also lowered his provisional income, which lowered the amount of Social Security being taxed, which lowered his AGI again. Wait, it gets worse. This circular calculation is one the IRS actually iterates through in their systems. Your tax software does it too, but the result is that the $2,600 senior deduction only delivered $1,430 in actual tax reduction for Harold. He lost $1,170 in effective benefit, not because the deduction phased out, but because the provisional income formula ate it from the inside. Some tax professionals call this the stealth phase-out. Others call it the tax torpedo. The IRS calls it nothing, because officially, nothing phased out. Technically, every line on Harold's return was correct, but functionally, he lost 45% of his senior deduction's value to a mechanism that was never designed to be understood by taxpayers. The IRS Taxpayer Advocate Service noted in their 2023 annual report to Congress, Report Section 1, Problem Number 8, that the interaction between Social Security taxation and standard deduction calculations creates effective marginal rates that taxpayers cannot reasonably anticipate without professional assistance. That's the government's own watchdog admitting the system is incomprehensible. I'd be curious to know, has your tax preparer ever shown you a line-by-line breakdown of how your Social Security taxation interacts with your deduction? Because in the comments on videos like this, the answer is almost always no. Most people see a final number on their return and never question whether that number could have been $2,000 lower. Now, Gerald Chen, 66, from Sacramento, California, took a different approach. Gerald's income profile was nearly identical to Harold's: $24,000 Social Security, $12,000 pension, $7,000 in savings interest. But Gerald did something in October 2024 that Harold didn't. He moved $28,000 from a CD that was maturing into a Roth IRA, a direct conversion. Counterintuitive, right? He paid tax on the conversion. But by removing that interest income from future years, Gerald permanently lowered his provisional income below the first threshold. Starting in 2025 and every year after, 0% of Gerald's Social Security is taxable. His effective additional senior deduction savings went from roughly $1,400 to the full $2,600 every single year. Over a 20-year retirement, that one October decision saves Gerald approximately $24,000 in total federal tax. The conversion cost him about $6,300 in extra tax that year. Net lifetime savings, $17,700. One decision, one afternoon. The difference between Harold and Gerald isn't intelligence or wealth, it's information. Gerald's accountant understood IRC Section 86 and how it interacts with Section 63F. Harold's didn't, and the IRS certainly wasn't going to explain it. There's a number I mentioned earlier, $44,000. And this is where I need to show you why it's the single most dangerous income level for married seniors filing jointly. This is the part most people miss entirely, and once you see it, you can't unsee it. Between $32,000 and $44,000 in provisional income for married filers, the tax torpedo operates at a 1.5 times multiplier. For every additional dollar you earn in that range, $1.50 of income becomes taxable, because each dollar adds itself to taxable income and drags 50 cents of Social Security into taxation alongside it. That's a 50% phantom rate layered on top of your actual marginal bracket. If you're in the 12% bracket, which most seniors in this income range are, your effective marginal rate in that zone is 12% times 1.5, equaling 18%. Uncomfortable, but survivable. But at $44,000, the second threshold activates. Now, for every dollar above $44,000, up to 85% of Social Security becomes taxable. The multiplier jumps to 1.85 times. Your effective marginal rate in the 12% bracket becomes 22.2%. And if a single additional dollar of income bumps you from the 12% bracket into the 22% bracket, which happens at $94,300 of taxable income for married filers in 2025, the combined effective rate can spike to 40.7% on that marginal dollar. If any of what I just explained made you stop and recalculate your own situation, and I suspect it did, hitting the like button takes 2 seconds, and it tells the algorithm to show this to other retirees who are sitting in that $32,000 to $44,000 danger zone right now without knowing it. That matters more than you think. Margaret Liu, 67, from Portland, Oregon, earns exactly $43,800 in provisional income. She's married, both spouses over 65. She sits $200 below the second threshold. Her tax advisor, a CPA with 15 years of experience, told her she was in great shape. But Margaret's husband, David, turned 72 in 2025. His first required minimum distribution from his traditional IRA is due by April 1, 2026. That RMD, approximately $8,400, based on his $215,000 balance divided by the uniform lifetime table factor of 25.5, will push their provisional income to $52,200. Not only does this activate the 85% Social Security taxability tier, it also triggers IRMSA surcharges for Medicare Part B and Part D, an additional $1,980 annually, because their modified adjusted gross income will exceed $206,000. Actually, no. Wait. The IRMSA threshold for married filers in 2025 is $206,000, so Margaret and David are well below that. I want to be precise here. Different thresholds, different mechanisms. The IRMSA piece doesn't hit them. But the Social Security taxation piece absolutely does, and it will cost them approximately $3,200 in additional federal tax they weren't expecting. Some advisors argue the Roth conversion strategy should happen before age 72 to avoid exactly this collision. Others say the conversion tax itself outweighs the benefit for lower balance IRAs. The math depends on your specific numbers, your state tax situation, and how long you expect to live, and that last variable is one nobody can calculate with certainty. Here's what matters. The $44,000 threshold hasn't been adjusted since 1993. 32 years of inflation have dragged millions of middle-income seniors into a bracket that was originally designed to affect only upper-income retirees. When Congress set that number in the Omnibus Budget Reconciliation Act of 1993, a household earning $44,000 was in the top 35% of retired households. Today, it's median. The trap has expanded to swallow the majority, and the IRS has no incentive to adjust it because it generates approximately $45 billion annually in Social Security taxation revenue. Let me shift from the national numbers to your specific situation because there are 4 defensive moves that work, and they work best when combined. Defense number 1, the qualified charitable distribution. If you're 70 and a half or older and you have a traditional IRA, you can direct up to $105,000 per year. That's the 2025 limit, up from $100,000 in 2024, straight from your IRA to a qualified charity. The money never touches your tax return. It doesn't appear in your AGI. It doesn't count as provisional income, and it satisfies your required minimum distribution. For someone like David Liu, Margaret's husband, directing his $8,400 RMD to their church or a donor-advised fund instead of taking it as cash keeps their provisional income at $43,800. Below the second threshold. Tax torpedo avoided. Richard and Paula Gomez, both 73 from Albuquerque, New Mexico, donate $3,000 a year to their local veterans organization. Before 2024, they wrote a check from their bank account and claimed it on Schedule A. Their accountant suggested switching to QCDs from Richard's IRA instead. Same charity, same dollar amount. But the QCD removed $3,000 from their AGI, dropped their provisional income below $32,000, and eliminated all Social Security taxation. Annual savings, $2,860. They didn't spend one additional dollar. They just routed the same donation through a different door. Defense number 2, strategic Roth conversions in the gap years. The years between retirement and age 72, before RMDs begin, are the lowest income years most seniors will ever have. Converting traditional IRA funds to Roth during these years fills up the 10% and 12% brackets cheaply. Every dollar converted now is a dollar that won't generate provisional income later. The key calculation: take the first Social Security threshold, $25,000 single, $32,000 married, subtract your expected annual Social Security benefit divided by 2, subtract your pension. Whatever's left is your free conversion space. For many seniors, that's $8,000 to $15,000 per year that can be converted at a 10,12% rate, preventing future taxation at effective rates of 22,40%. If you've made it this far into the video, you're clearly someone who takes their financial future seriously. Subscribing means you'll see the follow-up video I'm releasing on the 2025 IRMSA income brackets and how they interact with these same provisional income rules, because what I'm going to reveal in that video directly connects to everything we've covered today about the tax torpedo. Defense number 3, tax loss harvesting in taxable accounts. This one surprises people. If you hold index funds or individual stocks in a brokerage account, not an IRA, a regular taxable account, you can sell positions at a loss, claim up to $3,000 in capital losses against ordinary income per year, and directly reduce your AGI. That $3,000 reduction drops your provisional income dollar for dollar. For someone sitting just above the $32,000 or $44,000 thresholds, a strategic December sale could be worth $1,500 to $2,400 in avoided tax. Beverly Dawson, 74, from Columbus, Ohio, sells one losing stock position every December, just enough to generate exactly $3,000 in losses. She immediately reinvests in a similar, but not identical fund, 31 days later, to avoid the wash sale rule under IRC Section 1091. That annual ritual has saved her $18,000 in cumulative federal tax over 6 years. Defense number 4, and this is the one most people tune out for because it sounds technical, so stay with me, is the Social Security timing optimization combined with provisional income management. Don't skip this. If you haven't claimed Social Security yet and you're between 62 and 70, The month you choose to file doesn't just affect your monthly